New York City, October 22, 1907. A line stretches 3 blocks down Broadway from the doors of the Knickerbocker Trust Company. Inside, tellers are handing out cash as fast as they can count it. $8 million will leave the vault in 3 hours. Then the doors will close. The third largest trust company in New York is finished. That same afternoon, the cost of borrowing money on Wall Street hits 70%. 2 days later, it will hit 100, not a year, a day. Leveraged investors are selling anything they can. Stocks, bonds, anything liquid to raise cash before they are wiped out. Gold-backed assets get dumped alongside everything else. Not because gold is worthless, because gold is the easiest thing to sell in a panic. Now picture this. September 15, 2008. Lehman Brothers files for bankruptcy. Gold had hit a record above $1,000 an ounce 6 months earlier. Within weeks, it will crash nearly 30% to $712. Hedge funds holding mortgage-backed securities they cannot sell are liquidating gold, the one asset they can sell, to meet margin calls. Now picture this. March 16, 2020. COVID has shut down the world. Gold drops 12% in a single week. The World Gold Council publishes a report the very next day. The title says it all: massive liquidation. Virtually all asset classes experienced it. And then March 2026. Gold drops 12% in a single month, the worst month in 13 years. The World Gold Council titles its official commentary with 5 words that the Fiscal Historian has been saying for years. Sell what you can, not what you want. Same pattern, same mechanism, same outcome. Every single time. Here is what keeps me up at night. Every single one of those panic sell-offs was followed by gold hitting a new all-time high. Everyone, and most people, sold at the bottom because they mistook a liquidity crisis for a gold crisis. By the end of this video, you will know exactly what happened in each of these 4 episodes, who sold, why they sold, and what gold did afterward. You will understand a mechanism that has repeated for over a century. Stick with me. Before we dive in, this is history, not financial advice. Do your own research. The mechanism has 3 stages. Stage 1. Leverage builds. Funds borrow to amplify returns. Stage 2. A shock hits and losses cascade across illiquid positions. Stage 3. Funds sell their most liquid asset to raise cash. Gold is liquid. Gold gets sold, not because it is weak, because it is strong. Because someone will always buy it. Same 3 stages, same outcome. Number 1. The panic of 1907. Here is what most people miss about this crisis. It had nothing to do with gold. It started with a failed stock manipulation. A mining speculator named F. Augustus Hines and his brother Otto tried to corner the shares of United Copper Company on October 14th. They drove the stock from $39 to $52 in a single day. The corner failed the next morning when short sellers found shares to deliver. United Copper collapsed, and because Hines was connected to a chain of banks and trust companies, the contagion spread. The Knickerbocker Trust Company, run by a man named Charles T. Barney, was linked to Hines through personal associations. On October 21st, the National Bank of Commerce announced it would stop clearing for Knickerbocker. The next morning, the run began. J.P. Morgan, the actual person, not the bank as we know it today, had returned from an Episcopal convention 2 days earlier. He dispatched a young examiner named Benjamin Strong to review Knickerbocker's books overnight. Strong would later become the first head of the New York Federal Reserve. Morgan assembled roughly $30 million in private funds. John D. Rockefeller contributed $10 million. Treasury Secretary George Cortelyou deposited $25 million in government funds into the banking system. The call money rate, the rate at which brokers could borrow, hit 100%. That meant if you had borrowed money to hold positions, you were paying the entire value of your position in interest every single day. What do? You sell anything you can. Stocks fell nearly 50% from their peak. Charles Barney, the Knickerbocker president, shot himself on November 14th after being refused an audience with Morgan. Gold itself was not attacked. Under the gold standard, gold was money, but gold-backed assets, stocks, bonds, trusts, were liquidated at fire sale prices because leveraged investors needed cash. The crisis led directly to the creation of the Federal Reserve in 1913. The lesson nobody learned: leverage kills. Not the asset, the leverage. Number 2. The 2008 crash. Gold hit a new all-time record of $1,011 on March 17, 2008, the same day Bear Stearns was rescued. 6 months later, Lehman Brothers collapsed. And then something happened that confuses people to this day. Gold crashed nearly 30%, from over $1,000 to $712 by October 24th. How is that possible? Gold is supposed to go up in a crisis. And it does eventually. But first, it gets sold, because hedge funds holding illiquid mortgage-backed securities that nobody would buy at any price needed to sell something to meet margin calls from their prime brokers. Gold was liquid. Gold had profits sitting in it. Gold could be sold in minutes. Lehman Brothers itself liquidated precious metals positions. The gold forward rate dislocated as bullion banks cut counterparty exposure. The mechanism was identical to 1907, just with different instruments and bigger numbers. And then gold finished 2008 with a positive annual return. One of the only assets to do so. It recovered above $1,000 by mid-2009. And by August 2011 it hit $1,917, a 163% gain from the crisis low in under 3 years. The people who panicked sold at $712 sold the strongest asset in their portfolio. The people who bought at $712 tripled their money. Quick pause. If you're starting to see that the headlines screaming about gold crashing are actually some of the best buying signals in history, subscribe to the Fiscal Historian. This is where I show you the autopsies so you see the patterns before they repeat. Number 3. The March 2020 COVID liquidation. This one happened in 12 days. Gold was trading around $1,680 in early March 2020. By March 16th, it had dropped roughly 12% to $1,470. Every asset fell: stocks, bonds, even U.S. Treasuries. The supposed safest asset in the world fell in price despite the Federal Reserve cutting rates by an emergency 1% on March 15th. When the dash for cash hits, there are no safe havens. There is only cash. The World Gold Council documented the mechanism in real time. Gold trades over $260 billion per day. That is precisely why it gets sold in a liquidity crisis. It is the most liquid market after U.S. Treasuries. And on March 15th, even Treasuries were being sold. Gold was the second most liquid thing in the room, so it went second. Risk parity funds, the ones that automatically rebalance between stocks, bonds, and commodities, were dumping gold because their volatility models screamed sell. CTAs, commodity trading advisors, the computer-driven funds, hit stop-loss levels and triggered cascading sell orders. Within 5 months, gold hit a new all-time high, $2,072 on August 7, 2020, a 41% gain from the March low. The fastest recovery in any of these episodes. The pattern held again. Leveraged institutions sell gold to raise cash. The forced selling ends. Gold recovers to new highs. The only question is whether you panic with the institutions or by what they are selling. Number 4. The January through March 2026 correction. Gold hit $3,500 on January 29, 2026, the highest price in history. The next day, it dropped more than 13% into sessions, the steepest single-day decline since 1983. Silver fell 34% in a single day. The catalyst this time was the appointment of Kevin Warsh, perceived as the most hawkish candidate, to replace Jerome Powell as Federal Reserve Chair. Then geopolitical escalation struck in late February. Interest rate expectations shifted. Margin calls cascaded. In March alone, North American gold ETFs shed $13 to $14 billion. 87 tons of gold left those funds. Managed money positions on the COMEX dropped by 22 tons for the month, with the sharpest weekly drop being roughly 40 tons in the third week. Computer-driven funds unwound their positions the moment gold broke below its 50-day moving average on March 16th for the first time in 7 months. The Bank for International Settlements published a dedicated analysis documenting that retail investors, not institutions, had been the main source of the preceding inflow bubble. Margin-triggered liquidations created a self-reinforcing loop. Everybody was selling because everybody was selling, and the World Gold Council, the most authoritative source in the gold market, titled its official March commentary with words that should be carved into every investor's desk. Sell what you can, not what you want. But here is what happened on the other side of the world. While North America was panic selling, Asian gold ETFs, led by China, posted $2 billion in inflows during the same month. While Western funds dumped 87 tons, Eastern funds absorbed the selling. By early April, global ETF flows turned positive again. 21 tons came back in the first week of the month. Goldman Sachs, which famously called gold a slam dunk sale in 2013 at $1,000, now has a target of $3,300. JP Morgan forecasts $3,675. Deutsche Bank says $3,500. Societe Generale, which published a report titled The End of the Gold Era in 2013, now calls $3,500 conservative. The same banks that told you to sell at $1,000 are telling you to hold at $3,100. That is not a contradiction. That is the pattern. They sell at the bottom and buy at the top, and then they tell you to do the same. Now, what goes to zero? Leveraged gold positions go to zero, not gold. The leverage. Every one of these 4 episodes destroyed people who held gold on margin. The margin call does not care about your thesis. It does not care about fundamentals. It cares about cash. If you do not have it, your position is liquidated. Physical gold holders, people who own the metal, not a contract, have never been wiped out in a liquidity crisis. Their gold dropped in price temporarily, but they were never forced to sell. And every single time, the price came back higher than before. The warning signs right now just lived through episode 4. The correction happened in January through March of this year. Gold dropped significantly, and it is already recovering. The United States has imposed a naval blockade on the Strait of Hormuz after peace talks collapsed. Oil is near $100. The Federal Reserve is stuck between inflation and a government that cannot afford higher interest payments. Central banks are buying gold at the fastest pace since 1950, and the managed money positions that just got liquidated have not yet been rebuilt. History says, what comes next? The leverage unwinds. The panic ends. The fundamental drivers reassert themselves. And gold goes higher than before every time. Not because gold is magical, because the conditions that drove the price up, deficits, money printing, geopolitical chaos, and institutional distrust of the dollar, did not go away during the crash. They got worse. The question is whether you will see the pattern or be part of it, because Charles Barney shot himself in 1907 after a crisis that had nothing to do with gold. Lehman Brothers collapsed in 2008, and gold holders who sold at $712 regretted it for a decade. And the people who panic sold in March 2020 missed a 41% rally in 5 months. The mechanism is the same every time. The leverage breaks. The liquid asset gets sold. The patient holder gets rewarded. The pattern is mathematical. The outcome is inevitable. The only variable is you.